Every month, a news headline announces new record house prices in Australia. Sydney reaches new median of $1.7 million. Brisbane median breaks $1 million. Melbourne prices hit all-time high. These headlines create a sense that something extraordinary is happening. People wonder, are we in a bubble? Will prices crash? How are we supposed to afford anything? But here's what nobody really explains. House prices breaking records is actually completely normal and predictable. It would be shocking if prices weren't breaking records. Understanding why this happens is crucial to understanding whether Australian real estate is actually in a bubble or just doing what it's supposed to do. I'm going to explain why house prices constantly break records, what that actually means, and whether breaking records is a sign of a healthy market or a sign of disaster. Let's start with the most important insight. You should expect house prices to break records regularly. If they weren't, something would be seriously wrong. The math behind breaking records. Record house prices are almost inevitable in any growing economy with inflation. Let me explain the math. Nominal versus real growth. There are two ways to measure house prices. In nominal terms, actual dollars, and in real terms, adjusted for inflation. Nominal prices breaking records almost every year is completely normal and expected. Real prices breaking records is rarer and more significant. Here's an example. Suppose the median house price in 2020 was $600,000, and in 2025 it's $750,000. That's a 25% nominal increase. The nominal record has been broken. But if inflation was 15% over that period, the real increase is only about 8.7%, or 25% minus 15. In real terms, houses have only gotten moderately more expensive, not dramatically. Most news headlines talk about nominal prices. New record of $1.7 million is the nominal record. But the real record, adjusted for inflation, might only be up 2 or 3% from where it was a few years ago. This is crucial because nominal records are largely meaningless. What matters is whether real prices are rising unsustainably. Why nominal records are inevitable. With inflation at 2 or 3% annually and underlying population growth creating housing demand, nominal house prices should rise about 4 to 6% per year on average. If they do, then in 20 years, the nominal median will be roughly double. Records will be broken nearly every year. This is normal. If nominal prices weren't breaking records, it would mean either inflation is falling, which actually indicates economic weakness, or real prices are falling, which might indicate a housing downturn, or the economy is stagnating, bad for everyone. So nominal records breaking constantly is actually a sign of a normally functioning economy, not a sign of crisis. But real records tell a different story. Real house price records, adjusted for inflation, are more meaningful. When real prices break records, it means houses are becoming genuinely more expensive relative to the overall economy. In Australia, real house prices have broken records in recent years. The median house was genuinely more expensive in real terms in 2021 to 2022 than at any previous point in Australian history. This is more concerning than nominal records because it indicates houses have become genuinely less affordable relative to other goods and services. But even this needs context. Real prices can rise sustainably if incomes are rising at similar rates. If real wages are growing at 2% annually and real house prices are growing at 2% annually, the affordability ratio stays constant. This is sustainable. If real wages are stagnant, but real house prices are growing 5% annually, that's unsustainable. This is what actually worries economists. Why house prices keep rising? The fundamental drivers. Okay, so nominal records are normal, but why do real house prices keep rising? Why do houses keep getting relatively more expensive? Driver 1. Constrained supply. This is the primary reason. Australia isn't building enough houses to meet demand. Australia needs to build 240,000 to 280,000 new dwellings every year just to keep up with population growth. We're only building 160,000 to 170,000 per year. That's a 70,000 to 120,000 annual shortfall. Over 20 years, that's a deficit of 1.4 million to 2.4 million homes. We're massively underbuilding. When supply is constrained, demand pressure builds on existing stock. Every additional person who needs housing can't buy new supply, so they bid on existing properties. This drives up prices. This is the core issue. Everything else flows from this constrained supply problem. Driver 2. Population growth exceeding supply growth. Australia's population is growing at about 1.3% to 2% annually. This is above historical trends due to elevated immigration. More people need housing, but housing supply is only growing at about 0.6% to 0.8% annually. 160,000 dwellings built on a stock of about 10 million. When demand growth, 2%, exceeds supply growth, 0.7%, prices must rise to equilibrate supply and demand. It's basic economics. For prices to stabilize, either population growth needs to fall or housing supply needs to increase. Currently, neither is happening at scale. Driver 3. Low interest rates and cheap credit. From 2010 to 2021, interest rates were at historically low levels. The Reserve Bank dropped rates to 0.1% during COVID. At 0.1% interest rates, borrowing capacity soared. Someone who could borrow $300,000 at 5% interest could borrow $500,000 at 0.1% interest. This extra borrowing capacity flowed directly into higher house prices. When everyone can suddenly borrow more, everyone bids more for property, and prices rise. Even though rates have risen from near zero, they remain historically low. At 3.6% in 2025, rates are low relative to historical averages of 4.5 to 6%. Lower rates than historical norms support higher prices than historical norms. Driver 5. Investment demand. About 35 to 40% of property purchases are by investors, not owner-occupiers. This investment demand amplifies owner-occupier demand. Investors are attracted to property by tax concessions, negative gearing, capital gains tax discounts, and by expectations of capital growth. When they believe prices will rise, they buy more, which itself causes prices to rise, confirming their expectations. This creates a feedback loop where investment demand can amplify price movements. Driver 6. Wealth effects and asset appreciation. As housing has become a larger share of household wealth and housing prices have risen, existing homeowners have become wealthier. This wealth effect increases their confidence and spending. Additionally, when people see their home value rising, they feel richer and are more willing to spend on other things or borrow against their home equity. This stimulates the broader economy and real estate market. Driver 7. Limited alternative investments. Australian retirees and savers have limited alternative investments. Share markets can be volatile. Interest rates on savings accounts are low. Bonds offer poor returns. Property, by comparison, offers capital growth, income, rental yield, leverage, and tax advantages. For risk-averse savers, property looks attractive relative to alternatives. This drives capital into property that might otherwise go elsewhere, supporting prices. Why building costs keep rising? If prices are breaking records, it's logical to ask, why don't developers just build more houses and increase supply? The answer is that building costs have risen dramatically, making many projects unviable at current prices. Construction cost inflation is 8 to 12% annually. Since 2020, building costs have been rising at 8 to 12% annually. This far exceeds housing price growth in most markets. Materials. Steel, timber, concrete, and other materials have seen significant cost increases. Supply chain issues, commodity price spikes, and global demand have pushed costs up. Labor. Skilled tradespeople are scarce. Wages for builders, plumbers, electricians, and other trades have risen sharply. Some construction companies report they can't find enough workers at any wage. Regulations. Building standards have become more stringent. Energy efficiency requirements, safety standards, and accessibility requirements all add cost. Interest costs. Construction finance has become more expensive. Construction loans at 5 to 6% cost more than the 2 to 3% rates available in 2020-2021. The viability problem. Many developments aren't viable at current prices because construction costs have risen faster than selling prices. A developer might analyze a project in 2022 and find it's profitable. Build 100 apartments for $400,000 each, sell for $550,000, earn $150,000 per apartment profit. By 2024, the same project costs $480,000 per apartment to build, but prices have only risen to $580,000. The profit margin has shrunk to $100,000. By 2025, costs are $540,000 and prices are $590,000. The project barely breaks even. The developer abandons it. This is why dwelling approvals have fallen from 200,000 in 2022 to 163,000 in 2024. Fewer projects are economically viable. It's also why housing supply isn't increasing, even though prices are rising. Developers aren't supply constrained by demand, they're constrained by cost viability. Why prices keep rising despite tight affordability. Here's where it gets counterintuitive. You'd think that when housing becomes very expensive relative to income, prices would crash as buyers are priced out. But that's not always how it works. Prices can keep rising even as affordability deteriorates because of several factors. Forced demand. People need somewhere to live. There's no substitute for housing. If you need a house but can't afford it at the current price, you have limited options. Buy anyway, stretching your budget. Buy something smaller or cheaper than you wanted. Move to a cheaper area. Rent instead. Live with family. Most people aren't willing to do options 4 or 5 long term, so they do option 1, 2, or 3. This sustained demand supports prices even as affordability falls. Equity extraction. Existing homeowners have built up equity in their properties. When they want to upgrade, they can borrow against this equity, giving them increased purchasing power. A person who bought for $300,000 and now has a $500,000 home with no debt can borrow $200,000 to buy another property. This borrowing power fuels demand. Family wealth transfer. Wealthier parents gift deposits to children or guarantee loans. This effectively increases young buyers' purchasing power beyond what their own income would support. About 30% of first-time home buyers receive parental support. This significantly increases demand at entry level. Investor capital. Investors continue buying even as affordability deteriorates if they believe prices will keep rising. Self-fulfilling prophecy. If enough investors believe this, they buy enough to make it true. Immigration. New migrants need housing. They bring capital with them or have employer support. This adds incremental demand that helps support prices. When record prices become concerning. Record nominal prices are normal. Record real prices happen periodically, but there are warning signs that real prices have become unsustainably high. Warning sign 1, affordability ratios at extremes. The median house price is currently 7.3 times median household income nationally. It's over 13 times in Sydney. Historically, houses were 3 to 4 times income. When ratios get to 7 to 13 times, it indicates houses are expensive relative to incomes. This doesn't mean prices will crash immediately. Ratios can stay high for extended periods, but it indicates vulnerability to any shock that affects incomes or interest rates. Warning sign 2, negative real rental yields. In many markets, rental yields have fallen below inflation. A property renting for 3% yield while inflation is 3% is earning 0% real return. This indicates properties are being bought for capital appreciation, not income. When capital appreciation expectations are the primary driver, you have speculative demand rather than fundamental demand. Speculation is less stable than fundamental demand. Warning sign 3, first-time buyer participation falling. When affordability deteriorates, first-time buyers get priced out. First-time buyers are usually 20 to 30% of the market. When that drops to 10 to 15%, it indicates supply might be shifting toward investors and existing owners. This reduces price stability because investor demand is more cyclical. Warning sign 4, building approvals falling. When building approvals are falling, future supply is tightening. This can support prices temporarily, but might cause supply shocks later. A declining approval trend usually predicts either eventual price falls if approvals never recover, or volatile swings in prices if approvals suddenly recover. Warning sign 5, household debt at extremes. Average household debt in Australia is over $300,000 and rising. Debt-to-income ratios are at record highs. When debt levels are extremely high, any shock that affects incomes or interest rates can cause major stress. High leverage amplifies both gains and losses. Currently, Australia shows all 5 warning signs, which indicates elevated risk. However, these warning signs don't predict timing. They indicate vulnerability, not imminence. Why this time might be different? Throughout this analysis, I keep saying Australia has high prices, but could sustain them under certain conditions. Why? Permanently lower interest rates? One theory is that global interest rates have permanently fallen due to demographic aging, slowing growth, and high debt levels. If rates stay lower than historical averages, higher house prices relative to income are sustainable. This was plausible in 2010. It's less plausible now with inflation returning and central banks tightening policy. Rates are probably normalizing rather than permanently falling. Higher incomes. Another theory is that incomes will eventually rise to match prices. This happens if productivity increases, technology enables higher wages, or immigration brings high-skilled workers. This is possible, but uncertain. Wage growth in Australia has been tepid for the past 15 years. Supply eventually increases. A final theory is that housing supply will eventually increase significantly through planning reforms, development incentives, or construction efficiency improvements. Some jurisdictions are implementing these changes, but most are moving slowly. If any of these occur, higher prices would be sustainable. If none occur, prices are vulnerable. The psychological factor. Why records matter, even if they're normal. Here's something important. Even though nominal records are mathematically inevitable, they still matter psychologically. When you see house prices hit all-time record of $1.7 million, it creates a psychological impression that something extraordinary is happening. It fuels both FOMO, fear of missing out, among buyers, and doom among non-owners. Politicians use record prices to claim they're addressing housing. Developers use them to justify higher rents. Investors use them to justify continued buying. Media use them because they're dramatic. The psychological effect of breaking records is real, even if the economic meaning is limited. This is why record headlines, while mathematically expected, still move markets. What record prices actually tell us? They tell us supply is constrained. If supply were abundant, prices wouldn't be at records. They'd be falling due to excess supply. The fact that prices keep rising and breaking records indicates supply is tight. They tell us demand is strong. Despite rising prices, people keep buying. They're not being priced out entirely. Demand remains strong enough to keep pushing prices up. They tell us affordability is deteriorating. Prices rising faster than incomes means affordability is getting worse. Fewer people can afford property without stretching their budgets. They tell us there's speculation. Some portion of buying is based on expectations of further price rises rather than on housing need or rental income. This speculation amplifies price movements. They tell us wealth inequality is increasing. People with property are becoming relatively wealthier than people without property as asset prices rise faster than wages. They tell us something needs to change. Current trajectory is unsustainable. Either supply needs to increase dramatically, demand needs to fall, or prices need to correct. None of these are pleasant for existing stakeholders. The historical perspective. Record prices aren't unprecedented in Australian history. Housing affordability has deteriorated before. In the late 1980s, Australian house prices surged and ratios hit 5 to 6 times income. In the late 2000s, they again hit similar ratios before the GFC caused a correction. After corrections, prices typically fall 10 to 20%, which eases affordability temporarily, but then resume rising as conditions normalize. This pattern suggests current records aren't necessarily the precursor to catastrophe. They're the precursor to price stabilization or modest correction followed by eventual resume of growth. The worst-case scenario, 30+% crash, has never happened in modern Australian history. The most likely scenario is stabilization or 10 to 15% correction followed by resumed moderate growth. What breaks record prices? If record prices are so normal, what would it take to reverse them? Economic recession. A serious recession with rising unemployment would reduce demand and push prices down. However, Australia has avoided serious recessions for 30+ years. Interest rate shock. If interest rates rose sharply to 6 to 7% to fight unexpected inflation, borrowing capacity would fall 20 to 30%, pushing prices down. However, this seems unlikely in the current environment. Supply shock positive. If planning reformed dramatically and dwelling approvals surged to 300,000 to 400,000 annually, supply would finally match demand. Prices would stabilize or fall modestly. This would actually be healthy. Immigration decline. If immigration fell sharply due to policy changes, population growth would slow, reducing demand. This would ease prices but hurt the broader economy. Credit contraction. If banks tightened lending standards significantly, fewer people could borrow as much. Demand would fall, pressing prices down. Sentiment shift. If buyer sentiment flipped from optimism to pessimism, demand could fall rapidly. A price crash could become self-reinforcing as falling prices create more pessimism. Any of these could cause record prices to stop breaking, but none are happening now, so prices likely continue rising in the near term. Stabilize eventually and potentially correct if conditions change. Breaking records is normal for an economy with growth and inflation. Whether those records represent genuinely rising affordability or concerning divergence between prices and incomes remains the real question. Currently, both are uncertain, so we have normal-looking record prices but with elevated uncertainty about sustainability. That's not as dramatic as housing bubble about to burst or housing market is healthy, nothing to worry about, but it's more accurate. Australian house prices probably keep breaking nominal records for years. But whether those records represent genuinely rising affordability or concerning divergence between prices and incomes remains the real question.